Activity-based budgeting.
Traditional budgeting can be classified as functional budgeting. Maybe you consider it dysfunctional budgeting, which is a great joke, but functional in this case refers to department budgeting, not its effectiveness. Activity based budgeting focuses on the activities that drive costs before assigning those costs to objects. Activity based costing, or ABC, practices have greatly improved cost analysis over the past few decades. Using the principles of ABC, activity based budgeting, or ABB, improves budget accuracy. I'm not going to get into the details of how to implement ABC and ABB. I will explain them conceptually, how they are related, and their potential benefits. First, we need to start all the way back with traditional costing.
Traditional cost practices started with the easiest cost tracking. It did a good job of allocating direct costs to products. It used more arbitrary methods to allocate overhead. This is fine if overhead is a small part of expenses. It becomes dangerous when overhead is large. It can lead to bad product unit costs, which lead to bad decisions. To be fair, this was done before computers, when calculation and reporting capabilities were limited. For simpler companies with low overhead, the benefits of more advanced costing didn't exceed the cost. As overhead costs increased, simple assumptions could no longer be used to allocate them. At the same time, computing costs and software sophistication increased, reducing the cost of analysis. In activity based costing, resource costs are first allocated to activities. Activity costs are charged to objects based on the number of activities the object drives or causes. Traditional costing usually allocates resources directly to objects, often using an allocation method that's less accurate than using ABC's activities. Here are the definitions for resources, activities, and cost objects. Resources are what's used or consumed in company activities. These can be identified in the costs and assets of the company. It's the costs of staff and materials. More broadly, it includes the intangible assets of the company, including those not captured in the balance sheet. Activities are what happens in a company. It's what people or processes do. As they do these things, resources are used. Once again, these resources may be people's paid time or the materials that they process. The activities are performed on behalf of and driven by the demand from the cost objects. Cost objects are often products or services. A market or customer can also be a cost object. Activities can be categorized by what causes each unit of activity to occur. Here is a table of sample categories. Unit activities occur with each unit produced or sold. Examples are the cost of a component part and the labor needed to install it. Batch activities occur when setting up a production batch, regardless of the number of units produced in the batch. An example is the setup of a production machine for a batch. Product activities occur for each product, regardless of the number of batches or units of products produced. An example is package design. Customer activities are driven by customer actions and not by the number of units produced. An example is a customer service call. Market activities occur for a market regardless of the customers, products, batches, units, etc. An example is a market specific marketing campaign. Entity sustaining activities are the cost of doing business, regardless of the amount of business, customers, or markets. Examples are the monthly financial statements and the annual tax returns. ABC improves cost measurement. Its benefits also go far beyond that. I'll list a few benefits in the next few slides. The first is more accurate profitability analysis. ABC allocates indirect and overhead costs more accurately to products or other objects than traditional costing. Customer profitability is more accurate because costs are assigned to customers based on the cost activities they have driven. Different customers drive different levels of activities and costs. A company can now calculate these per activity costs and track their frequency. Customers who cause more activities, for example, transactions or services, are charged more expenses in customer profitability analysis. Channel profitability and pricing are improved. In banking, we could decide how much mobile banking transactions cost versus branch transactions. We could then encourage customers to use more profitable or less costly channels. ABC breaks the black box of overhead costs into a series of identifiable actions for which there are costs. This has many corollary benefits. Better identify efficiencies and waste. The process documentation of ABC goes hand in hand with process improvement methodologies like Lean Six Sigma. In Lean Six Sigma, each process must prove how much value it provides, especially to the customer. The linkage from one activity to the ultimate customer is clear and traceable from the ABC activity linkages. I've discussed earlier the importance of knowing the total and remaining capacity of assets and resources. Capacity constraints limit production. Increasing capacity often triggers step fixed costs. Marginal profitability is massively different for production using excess capacity versus production that triggers high marginal costs. ABC helps assess the potential capacity of resources and the actual amount consumed by the activities. ABC maps linkages from customer actions to production activities and then to overhead activities. It's not possible to estimate how many extra HR staff would be needed if production tripled without this activity linkage. I'll expand on this later. ABC provides an excellent way to challenge budgetary slack or sandbagging that's rampant in budgeting. Past relationships and linkages provide solid evidence of what costs to expect in the future based on budgeted revenues and production. Expenses in excess of this must be challenged. Justification for resource allocation. ABC helps define a cultural battle that wages in many companies. It becomes even more pitched during budgeting when managers compete for scarce resources. Activities drive other activities. Costs cause costs. That may not always be clear, but ABC is a good way to bring it to light. Let me walk through a slightly caricatured account of how the battle plays out. Sales staff claim to be the rainmakers that bring in all the revenue. They claim a small investment in salaries and staff for them is leveraged into massive revenue increases. Production employees contend they actually create the product or provide the service the customer wants. They do the real work for what the customer gets. They see sales as just glad handing pretty people order takers. Production demands more resources if sales go up to pay for the increased cost of materials and to hire more people because the existing staff is already overworked. Both sales and production staff consider overhead departments to be blood sucking leeches. They suck away profits created by sales and production while trying to tell everyone else what to do. More specifically, budget season is when the rest of the company feels that the financial overhead people are sucking copious amounts of the lifeblood resources from the company. Sales staff can easily claim they need resources because those resources improve revenues. Production staff can easily point to the variable direct costs that will go up from increased sales. How do indirect and overhead teams justify their need for more resources when production and revenue increase? Isn't overhead a fixed cost that doesn't need to go up with production? Overhead teams provide services, but what drives those services is very indirectly linked to the sales of production. The costs derive from different activity categories like product, market, or entity sustaining activities. The number of employees, locations, and departments also increases activities and costs for overhead departments. ABC shows this connection of activities. The nebulous fixed cost perception of overhead is broken into component activities which can be assessed for capacity utilization. Thus, accountants and financial analysts may implement ABC if only to justify their existence. It shows the benefits they provide directly to internal customers and indirectly to external customers. It substantiates their costs and might even clarify their purpose for living, or at least their purpose for showing up for work. As I've said before, budgeting is accounting in reverse. However, the budget follows the sequence of events as they occur in real life. In ABB, customers are going to buy products and services, in other words, objects. This will cause our company to perform activities to meet customer demand. These activities will consume resources and create costs, which will be recorded in the budget. The image here shows how the flow of the analysis in ABC is the opposite of the flow of how costs are compiled in ABB. In fact, we're back to the budgeting flowchart again. The flowchart starts with the key assumption of volume and price. That drives the production activities. We know intuitively that those activities will drive other activities in overhead departments. ABC helps us quantify those activities and the related resources of costs. Instead of one big arrow from the cost of goods to administration or one big arrow from production to manufacturing overhead in the budgeting flowchart, ABB has many arrows. Each arrow is an activity driven by another activity. Each of these arrows has a cost per activity. The job of everyone in the budgeting process is to estimate the volume of activities and the price per activity. This should sound familiar. This is the concept I explained earlier of how an income statement is just a collection of volumes and prices. However, ABC and ABB make a crucial change in cost categorization from traditional budgeting and costing. GAAP income statements, like many budgets, categorize costs by the organizational structure. The budget is likely set by the manager of each department. They are finance's expenses, HR's expenses, and IT's expenses. If budgeted expenses grow a lot over the current year's actual expenses, their supervisor or other senior leader may challenge these budgets. Those people will demand, "Why are your costs going up so much?" The logical leap from sales goals to the functional budgets of overhead departments is massive. It can't be made in one intuitive leap. It's better understood step by step via activities. The answer may be ABB. In the lesson on testing budgets, I mentioned that one test is to compare past ratios between staffing and volumes to budgeted levels. This is a rough estimation of correlation. This is like the leap of logic. An overhead department manager knows that their staff is busy and more staff will be needed since the budgeted revenue is higher than this year. And yes, budgeted revenue is almost always higher than past actual revenue. That intuitive linkage is shown in the web of ABC activity linkages. The amount of additional resources needed can be calculated from ABC data from finance. Once again, finance saves the day, or at least the budget. If most budget lines are a collection of volumes times unit costs, can we just take the budgeted number of activities times the ABC unit cost to calculate our budget? No. The average historical cost for an activity per an ABC analysis is not its marginal cost. As more items are produced and more activities are performed, the capacity utilization changes and cost efficiency changes. There may be large differences in costs in the future for additional items. For example, past material or labor costs may be much lower than the future material or labor costs. However, the analysis used to create the activity costs is an excellent starting point for calculating marginal costs. Cost is a function of capacity. If there is excess capacity, then marginal costs are very low to zero. If capacity is exceeded, then a step fixed cost will need to be incurred. Overhead costs are primarily step fixed costs, for example, hiring a new employee. ABC does an excellent job mapping the activities and the time, in other words, capacity utilization, of these activities done by indirect and overhead departments. Capacity utilization is a function of the number of activities. ABC can help managers determine the capacity of a resource. The process management of ABC can help improve the efficiency of the resource to increase its capacity. Process management may also change process flow to reduce activities or route volume around bottlenecks. Mapping the revenue target to activities allows managers to check if there are enough resources for that level of activity. Many surprise expenses are due to poor capacity assessment during budgeting. Let's look at a simple activity based budget analysis and capacity utilization scenario. The example narrative is based on this image. Let's assume ABC Company produced 100,000 units of product A. This required 100 production batch setups. This equals an average of 1,000 units per setup. Each production batch setup takes 8 hours of labor. At $40 of salary and wages, each setup cost is $320, and the total setup cost that can be allocated to the product and its 100,000 units is $32,000. The CEO just announced that they are going to 5x sales in the budgeted year. Let's assume that means they will need to 5x their production. $500,000 units divided by last year's standard of 1,000 units per setup equals an estimated 500 setups. The ABC cost per setup was $320, but this has been adjusted to $400 per setup for next year. Labor costs, including costs to lure new workers to the company, are expected to be higher in the budget year. At 8 hours per setup, the total setup time will be 4,000 hours. This is 3,200 hours more than last year and equals roughly 1.5 FTE, or full time equivalents. They will need to hire 2 people for this. HR calculated that it takes them 100 hours to process each new hire. This includes recruiting, screening, interviewing, onboarding, and training each new employee. Hiring 2 people for setup will cost 200 hours of work for their department. If this was the only additional work for them and they had excess capacity, they wouldn't have to hire another HR person. If they were at capacity, they would have to hire another HR person to have time to hire the 2 setup people. Ironically, hiring the HR person also causes another 100 hours for the HR department. It's another iterative loop in budgeting. The ABC work that calculated the hours per setup, units per setup, hours per new hire allowed the company management to quickly budget the number of new hires needed solely due to the setup. The number of new hires was contingent on capacity assessments of current staffing. ABB has many compelling benefits. More accurate budgeting. By focusing on activities, activity based budgeting can provide a more accurate picture of all the costs associated with budgeted production levels. Better resource allocation. ABB helps to allocate resources more effectively by identifying and prioritizing the activities that create the most value for a company. Capacity management is greatly enhanced. Improved decision making. With a more detailed understanding of the costs associated with various activities, ABB can help managers make better decisions about what products to promote and which customers to pursue for increased profitability. It can slowly be integrated into budgeting as ABC analysis is done on processes or departments. ABB also has some drawbacks that need to be considered. Activity based budgeting can be a time consuming process requiring significant effort to identify and analyze the costs associated with various activities and the expected number of activities. ABB and ABC rely heavily on accurate data about the costs associated with different business processes. If this data is not readily available or is difficult to collect, the accuracy of the budget may be compromised. ABC and ABB can be a complex process requiring a deep understanding of a company's operations and activities. The web of activities can be complex. This complexity can be difficult to clearly communicate in a compelling way to create buy in for it. While ABB provides some data to improve the projection of activities and costs, it may challenge the views of some managers that I covered in the company culture section. I've built profitability systems that produced results that some people had a hard time accepting, even though it was based on information and assumptions from them. ABC can produce very different product and customer profitability results than long used traditional costing methods or management intuition. ABB does a better job of capturing all the costs of growth. This makes it harder to hit budget profitability targets by increasing growth. This may not be a con, but it is a challenge.